Henry said that the speed with which the downturn has gripped the financial markets means that the assumptions of U.S. and Europe insurers that underwent share buyback programs 3 months ago to cover capitalization, to overcapitalize, means that they could return to the market, let me make sure I get this straight, that the efforts of several major European and American insurers that underwent recapitalization efforts have now been proved fruitless. Reduced investment income levels have strengthened the need for underwriting profit, Keeling said. Underwriting profitability increasingly will have to be king. With investment income unreliable and under pressure, management, boards of directors, and rating agencies are all going to be focused on that, so there will be even less appetite and less elasticity for underpriced risks that people had early in the year. Keeling described AIG as the, quote, 800-pound gorilla in the room. He said strong anecdotal comments, again denied by AIG, suggest that the company is fighting very hard to hang on to the renewal portfolio. He said, quote, of course they have very strong client and broker relationships and that will help them, but it's more in the area of competition and price cutting that the critics are attacking AIG. Henry Keeling said he expected the insurance market to harden as early as the January insurance renewals. We've known Henry for a long time, and these are some very, very sober and on-point comments by a very well-respected member of the industry. We will endeavor to have him on this program in the very near future and maybe ask him some more details about his thought. Here's an interesting story that we noticed. It hasn't been picked up elsewhere, but Goldman Sachs Group will pay $100.5 million U.S. to former policyholders of defunct insurance company General American Life Insurance. This is in a settlement. The agreement was finalized in the capital of the state of Missouri here in the U.S., Jefferson City, yesterday. The suit had been filed in Missouri State Court against Goldman and Morgan Stanley, which had been hired by the insurer, General American, for financial advice in an effort to go public 10 years ago. The suit alleged that Morgan Stanley and Goldman did not give proper advice to the insurance company. The two banks advised General American to go public in January of 1999, and the company went bankrupt 8 months later. The St. Louis court confirmed that the parties had notified it about a settlement. Here's the interesting part of this. The money is going to be going to a liquidator because American General is already in liquidation. In 1999, General American claims that it had issued $6.8 billion of short-term funding agreements that had been done apparently with the advice of Goldman and with Morgan. After putting the short-term money agreements out, money fund managers purchased them since they paid higher rates than most short-term investments, and they could be redeemed with only 7 days' notice. These were very attractive bonds. However, then, Moody's Investor Service downgraded its rating on General American on concerns over the eroding market value of General American's long-term investments, inspiring a run on the bank. General American was caught then in a liquidity squeeze, and it agreed to be sold to MetLife for $1.2 billion. The spokesman for Goldman did not comment. It's interesting to remember what was going on 10 years ago. It was the height of the dot-com hysteria. Companies that had simply notional business plans were being capitalized at huge amounts of money, and the traditional blue-collar, conservative, brick-and-mortar kinds of businesses such as insurers were beginning to be approached by investment banks as possible candidates for IPOs themselves in order to join into the feeding frenzy of investor capital that was then rampant in the marketplace. It's going to be very interesting to see if this successful lawsuit on the part of American General or General American inspires anything else in the future. We have some reinsurance news. The board of Heritage Managing Agency in London, which is a member of the Argo Group International Holdings Organization, today announced the appointment of a well-known veteran, John Spencer, as a non-executive director. Spencer had formerly been the CEO of BMS Group, Valentine, McKeon and Sullivan, the London-based broker. He's also served as deputy chairman of the London Market Brokers Committee. And Spencer, not to be forgotten, added to that, let me add to this, Heritage has picked up another plum. This would be Neil Chapman, who has left his role of Deputy Business Group Leader at Catlin Insurers to become Joint Active Underwriter at Heritage. In additional news in the marketplace, Michael Bannon, Assistant Vice President of AIG's London Aviation Insurance Division, has also joined the Global Aerospace Underwriting Management Group, GAUM. He is the latest in a growing number of senior figures to leave their post at AIG. GAUM actually is the largest worldwide underwriter of aviation insurance. It manages one of the biggest pools in the world with insurers such as Berkshire Hathaway subsidiary National Indemnity, Tokyo Marine, Munich Re, and Mitsui. The Insurance Insider, which provided this information, also understands that a further senior AIG aviation figure has also been poached by CV Star Underwriters. We don't have that name yet, but we'll see if we can find it. Let me do one more check on General Motors here. And if not, we'll go to a word for a break. Nothing yet. Okay, we'll go to a word from our sponsors and come back with the rest of the news.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes confidence, passion, innovation, and understanding.
Enabling opportunity.
Protecting capital.
Engineering innovation.
Investing in your future.
Ensuring continuity.
Finding the right balance.
It takes Aon.
The Dow Jones Industrial Average is up about 160 points. There's still no word on General Motors. There is word on a big storm in the upper Midwestern part of the U.S. Believe it or not, and I guess it's not that unusual, this is after all the 7th of November, a huge blizzard has pummeled the state of South Dakota. Snowfall neared about 4 feet in the Black Hills region of the state. Winds were gusting more than 50 miles per hour, creating near whiteout conditions. The South Dakotan authorities have a very simple message for anyone thinking of trying to drive in western South Dakota right now, and that's don't. They stress that the storm, which has stranded an unknown number of motorists out on the highways, have knocked out power to thousands of people and will continue to cause problems as it moves eastward across South Dakota today. The governor said that this is a dangerous storm. The whole state is basically under a no-travel advisory. Officials closed a long stretch of the interstate that runs east to west out there, Interstate 90, where dozens of vehicles have been trapped. Some motorists have been stranded more than 24 hours. Top speed for some of the rescue crews is as little as a half mile per hour. The storm dropped 45.7 inches of snow near Deadwood in the northern Black Hills of South Dakota, and 20-foot snow drifts have been reported on the Pine Ridge Indian Reservation. Much further to the south, Cuba is getting ready. They're facing a hurricane watch now as Hurricane Paloma is barreling toward the Cayman Islands and is on a path to hit the island again. Watches have been issued for the provinces of Sancti Spiritus, Las Tunas, and Granma. A hurricane warning is in effect for the Cayman Islands, and the storm, which is now a Category 1, is going to hit there late today. At 7 a.m., Paloma was about 85 miles south-southwest of Grand Cayman.